Hey everyone, I'm just going to make another quick video here for PFIN. Just a couple things to mention. Sorry, this camera kind of sucks. I'm just using my laptop from work. It'd be better if I could use my phone camera, but I need to use my laptop so that I can share my screen with PowerPoints and other documents and stuff like that. So first off is we didn't completely finish chapter 6 in class. I'm just going to quickly cover the end of chapter 6. And then one other thing to mention, I'm just going to share the screen here. So it was pointed out to me that on this completion guide that originally when I showed it, chapter 7 wasn't included. And I don't know what happened if people didn't get that in their homework package or what, but there is a chapter 7 assignment and it is on Moodle. And so I've added it here and I just made it worth 1% and changed chapter 6 to 3%. So yeah, and then you can submit those assignments by email or Moodle. I believe on Moodle there's a submission portal. So yeah, if there's any questions about this completion guide or any of the assignments or whatever, just let me know. Sorry if things are kind of a little bit disorganized. We've kind of been rushed just to throw things together. So things are a little bit scattered, I guess, but I'm trying to be organized. Plus we're kind of just making things up on the go and not really sure, how everything's going to play out. But yeah, always just send me an email if you're confused about anything or something's not clear. So yeah, I'll get into chapter 6 right now and just finish that off quickly. And you can see too, this is what it's going to be like for my future videos. Just make that full screen. So chapter 6 was looking at credit, sources of credit. And we got through most of the chapter already in class. I'll just quickly go over the end of the chapter stuff and focus on the key points. So this is around where we left off: fixed rate installment loan and floating rate personal line of credit. So that fixed rate, usually that's talking about interest rates, where like with a mortgage, you can have a fixed or variable interest rate. So if it's fixed, it means you're locked into that given interest rate for the term of the mortgage or the loan. Whereas a floating rate, whether that's personal line of credit, like it says here, or mortgage, like a variable rate mortgage, it means the rate is not locked in. And that's standard for sure with lines of credit, but I think more people with mortgages go with fixed rate mortgages. So for example, with a line of credit, you might get approved for a line of credit worth $10,000 with prime plus 3 or whatever. So maybe that's like whatever is 7% interest rate. But if the prime rate goes up, overnight your interest rate is going to go up, which means you're going to be paying more. Whereas if you have a locked-in interest rate, like with a fixed rate mortgage, and the prime rate goes up, or overnight lending rates go up, like they've recently gone down actually, but if they're to change in either direction, you're not going to feel it if you have a fixed rate loan or mortgage, because you've locked in, it's fixed, it's not variable. The cost of credit, so just how those are calculated, that might be adjusted balance method, previous balance method, or average daily balance method. So the adjusted balance method, they're just removing finance charges or payments during the billing cycle. I would say the more common one would be the average daily balance method. So like if you have a line of credit, most banks are going to be just looking at how much you're using each day and then charging you based on that for the billing cycle. Previous balance method, so that's not giving credit for payments made during the billing period. So they're just looking at how much you had outstanding at the original date and not taking into consideration the fact that your outstanding balance has dropped during the billing cycle from payments being made. One other thing here that's pretty important, but it's been covered. We've talked about inflation already, and you've covered that in macroeconomics. Obviously, inflation is just when cost of living is going up, prices are going up. So that can impact whether you're lending or borrowing, and the impact it has on the value of money. Yeah, purchasing power, basically. So something to keep in mind there. If you're making a loan to someone over the course of many years for a really low interest rate, the interest you're getting back might not even cover the increase in inflation. So it might not be worth loaning when you take that into consideration. Next point, avoid the minimum monthly payment trap. So we've talked about that too with credit cards. Like if you're just paying your minimum monthly payment on your credit card, you're never going to get out of that unless maybe your total outstanding balance is like $100. But if you have four, five, whatever, $8,000 outstanding on your credit card and you're just making the basic monthly payments, those basic monthly payments aren't even going to cover the interest you're charging you. So that even if you're not spending more on your credit card, you're going to have a greater and greater balance if you're only paying your minimum monthly payment. So it's a trap to avoid for sure. Credit insurance. I mean, most credit cards are going to have that, not just credit cards, but lines of credit, mortgages, things like that. With mortgages, we'll get into that a little bit more in Chapter 7, but you maybe heard of like CMHC insurance, where if you're getting a mortgage, you're buying a property and you're paying less than 20% as a down payment, you have to get this extra CMHC mortgage insurance. Managing your debts. Things can happen. Sudden illness or loss of job may make it impossible to repay your debts, and that's something that's obviously going on right now. I just heard that like 2 million Canadians have applied for unemployment insurance since like March 15th or something. So in like 3 weeks, 2 million Canadians. That's a huge percentage. It's like 10% of working Canadians, more than 10% of working Canadians a month ago now are not working and applied for EI. So there's going to be a lot of people who can't pay their debts right now. Contact your creditors at once to work out a modified payment arrangement. The government's kind of stepping in with that right now too. Vehicles can be repossessed if you're defaulting on payments. Even with homes can be repossessed under certain circumstances. That's more common in the United States though. But there are like bank foreclosures. My father and I just went and looked at a townhouse a couple months ago that was owned by the bank because the previous owner couldn't make their payments. They were defaulting. Debt counseling services are available. I'm sure most people have heard of that before. Some warning signs of debt problems. Need for instant gratification, use of money to punish, keeping up with the Joneses. Maybe you've heard that term before. I know my brother kind of mentions that. It's trying to maintain a social or public image that you're kind of keeping up with the affluent people, dressing a certain way, having vacations or nice vehicles, to make it look like you're kind of keeping up with the wealthier class or whatever, or just a certain image. Overindulgence with children. Sometimes I think people feel like maybe they're not around their kids enough, and so they want to make up for that by spending more money on them. I've definitely seen that before. High finance charges. Continually going over your credit card limit would be a huge warning sign. Living paycheck to paycheck. Utility services cut off or unpaid bill. Yeah, so just some obvious like warning signs that you're not managing your debts properly. Last thing for this chapter is just looking at declaring personal bankruptcy, which I won't talk about too much. We've covered that in law class as well, bankruptcy and insolvency acts and stuff. But yeah, you can just kind of look at the points here. It is increasing, and it is well-educated middle class baby boomers that just have taken on a lot of debt, usually between the ages of 40 to 44. So that's something that's really growing just by the way our society is trended. Like debt is such a common thing now, whereas it never really was before. 40 years ago, people didn't have credit cards and as much debt as they do now. It's basically become the norm now. So of course we're gonna have more people defaulting on payments and filing for bankruptcy. Consolidation loans, we've talked about that a little bit before too. That's just consolidating debt. So if you have a mortgage with one bank and a line of credit with another bank and a credit card with another bank and a student loan with another bank, kind of just bringing that all together and having one consolidated loan where all your poop is in one group, so to speak. You might get a better interest rate and better terms. There are advantages and disadvantages. And then the Bankruptcy and Insolvency Act, you can just kind of browse through that on your own. Just some steps in declaring personal bankruptcy. We covered this already, I think a little bit in this class, but also law class. Like we talked about secured creditors being paid first. Yeah. Just some changes to the Bankruptcy and Insolvency Act. Anyways, I'll stop sharing that. So that probably was a little bit longer than expected. I just wanted to go through it and touch on some key points. But yeah, I'll do the same thing for Chapter 7 coming up shortly. Again, thanks for watching. Maybe you could even just subscribe to the channel and then you'll see when there's videos being posted. But as always, just send me an email if anything's not clear, or if you need some extra explanation, or if I missed anything. That's it.